Okay.
It is on the bottom of the screen.
It is on the bottom? Okay, cool. So then if you guys have questions, enter them there. Or if I miss them, just, you know, we're very informal. So just raise a hand, do a shout, whatever you need to do. Okay. So we're going to talk about all things credit on this one. So it is good for everybody. These are things that everyone should know. And there's so many miscommunications out there with regards to the mysteries of credit. So I will do my best to uncover all of that for you guys today. So we'll start with our very first screen, because the number one question that we get at least once a day is, why is your credit score different than what I see on Credit Karma and or my, you know, trade lines for the bank or my credit cards, etc. The reason that it is different, where's my notes? The reason that it's different is because Credit Karma and some of those kind of free credit reporting agencies use a different credit model system. It's called the Vantage score. And the Vantage score is different than a FICO scoring model. 90% of financial institutions use a FICO scoring model. And the reason is that we try to get the same data, but the Vantage model just scores things a little bit differently. Like inquiries, they score way easier than the FICO system does. They will also look at some different things with regards to their scoring model. Their scoring model will go up to a little bit higher than the FICO model. So they're just a little bit different. They shouldn't be completely off, but in general, we do find that the Credit Karmas and those kind of things tend to be a little bit higher than our FICO model, because we definitely will weigh things a little bit more mortgage driven, a little bit more debt heavy, and we'll go through that in a little bit. But that is the reason why your credit scores are different than when you go to have your mortgage inquiry done, or maybe a car loan or something like that, versus, hey, I got pre-approved for this, or I looked on my credit card and they said my score was X. Two different models, two different systems. A Vantage score is typically used when you're not applying for anything specific. So pre-approved screenings for credit cards will all use a Vantage model. Insurance, some of those things that maybe there's no specific application is going to use a Vantage model because it has no ability to hurt your credit score with regards to inquiries, but it will give people a good idea of what things look like. So that's the number one question we get for credit. Why is it different? The number two question that we get, and this probably is, I don't know, 3 times a week maybe. Will pulling my credit bring my credit score down? And this is a really common one in mortgage or with cars and things like that. So yes, potentially is the answer. And what I want people to know is, in a FICO scoring model, which is really what every mortgage company is going to use, you have about, and I got to double check my notes on this, but you have 30, hang on, I got to double check because I don't want to tell you the wrong one. You have 30 days to basically shop around, and it's going to be considered one hard inquiry. So the question I get all the time is, I got approved over here at this mortgage person, they pulled my credit, and that was 2 weeks ago, and I don't want you to re-pull it because I don't want my credit score to go down. As long as we're in that 30-day window, it will not move. It will only count as one hard inquiry. So I always tell people, as long as it's within the time frame, you're okay. Same thing with cars. Cars, if you are in a 30-day window and you have multiple inquiries, because sometimes when you do a car loan, they will want to pull and kind of shop it around to a bunch of different places, but each one of those places will then do a quick inquiry. And again, as long as for a FICO scoring model, as long as it's a like inquiry, meaning mortgage and mortgage, car and car, it's going to act as one hit. And does it pull your credit score down? A little bit, but if your credit is already pretty good, maybe 5, 6 points, shouldn't do a whole lot. If your credit is already, you know, definitely lower, then usually the hit's going to be a little bit more, maybe anywhere from 10 to 15 points, just depends. Okay. Next slide. So we are mostly going to talk about the FICO model today, just because 90% of the mortgage and banking industry and finance industry use it. And every time we do a credit score inquiry, we are always going to pull from 3 different bureaus: Equifax, TransUnion, and Experian. Each one of those are going to give us a different score, and each one of them may have different data. Like sometimes I will see a client's information that has a 680 for Experian, but they've got a 740 and a 760 with TransUnion and Equifax. It's just, if I look at their credit score, something bad is reported only to Experian and not to TransUnion and not to Equifax, which is why sometimes you get those disparities. It's why we pull 3 credit bureaus, so we can get a view of all 3. Okay. Credit score can be 300 to 850. Very rarely are we going to see, I mean, we see 810, we see 815. Those are typically people with a long history, a really nice mix of credit. But really in our world, anything over a 760 is going to give you the best mortgage insurance or interest rate score. And if you don't have to worry about mortgage insurance, then a 740 is going to give you the best interest rate. So this is how it comes up. So payment history is 35% of what will make your credit score higher or lower. So how you simply have paid your debt in the past. Amounts that you've owed, 30%. So we'll talk about this in a little bit more detail, because that is something that we can play with and kind of work with. Length of credit history, obviously the longer you have credit, the longer history you have, the more data we have to say, yes, they're a good risk, no, they're not. And then new credit and types of credit used. So when we're looking at, you know, probably the 3rd biggest question is, how do I get my credit score higher? What should I be doing to get my credit score higher? This is where we would focus. So sometimes it's like, well, should I change up, you know, the mix of credit that I have? Installment debt, student loans, credit cards. No, that doesn't help a ton if your credit history bites. So we'll really focus on the bigger pieces of the puzzle because they add more impact. Okay. And just so you guys know, for some odd reason, because I have my screen on to move the thing, I can't see the chat box. So if you guys have questions in there, you have to unmute and just belt them out, so I don't just ramble on for half hour. Okay, so why are credit scores different? Because there are 9 different platforms, things that are viewed differently, versus just a mortgage is not the same as a credit card history. So very different in how those are weighted. So when we look at your payment history, again, if you've got late payments, it's not the end of the world, but it will affect your credit. And about 2 years is the window of time that they will go away or quit hurting you. They'll stop hurting you badly after a year, but after 2 years, the effect of that late payment will pretty much be gone. So again, if you've got late payments, just know that that's the mountain that you're climbing of time. So again, if you've got 1 late payment in your whole entire history, that's not going to be nearly as detrimental if you've got obviously multiple ones. And the first late is always going to hit you the hardest. So if you've got a late payment and you've never had one before, that is going to move your credit score the most, versus if you have a subsequent payments beyond that. I know it seems counterintuitive, but that's how it works. And definitely the way that things are looked at, with a mortgage having the most amount of impact, installment loans having the 2nd most amount of impact, credit cards having the 3rd most amount of impact. So if you're late on a mortgage, it's definitely going to move the needle more than if you're late on a Kohl's card. Okay. Okay. Length of time since delinquency. So again, I talked about after 2 years, if you've got things that are hitting you, they'll come off basically after about 2 years, or the kind of the pain will stop digging at that credit score. Public records, so civil judgments, federal tax liens, bankruptcy filings, these are a little bit different. Their time is going to be a little bit longer before they'll start to drop off, but those are public records and those are going to hit you a little bit harder. Now, the second area that is going to have the most amount of impact on your credit score is going to be the amount that you owe on revolving cards. This is probably the #1 challenge, I think, that when people have a little bit lower credit score, that this is usually the culprit. Balances. So when you are given a credit card and maybe you've given a credit card and the balance or the limit is $3,000. I know, believe it or not, you are not meant to use all 3,000. You are meant to use less than that. And how you manage that usage is how your credit score is factored, or that's the impact of that factor. So the best thing that you can do is try to keep about 30% of your usage based on the credit limit, okay? So if I have a calculator, so I'll cheat. So I've got $5,000 as a credit limit. To keep that within 30% or less to maintain the highest score, my balance would never tip over 1,500, okay? So again, when I see people with credit cards of, you know, balance of 5,000 and, limit of 5,000 and their balance is 4,500, that's really hindering your credit score. And you've got 2 or 3 of them, that is really hindering your credit score and bringing it down. You may have never missed a payment, but if your credit usage is too high, you're going to get nailed like you almost did miss a payment. So one thing that I will always recommend to clients is you should have more than 1 credit card. And I usually recommend 3. I don't love the store credit cards because I think those can get a little out of control, because when we see people opening up a bunch of credit cards and it's, oh, I saved 20% here. Usually your limits are small. And so if you've got a limit of 500, you spend, you know, $200, you're already challenged with your credit score being hit on that. So I don't love the store ones, but I do like 3 major credit cards. And the reason is that if for some odd reason you start to tip above 30, 40, or 50% of a balance limit on a card, you can start using another one and work on paying that down, and your credit score will remain intact. So I just think that sometimes in life, I know we don't love credit, but we're also realist about what is out there and what we have to use and how things pop up and happen. Home equity line of credits can also be considered revolving. So keep in mind that if you've got a home equity line of credit that you took out for $100,000 and you borrowed $100,000, that is also going to sometimes hit you on that limit. So work on getting that a little bit lower. Other thing that I always recommend for people is don't be afraid of the balance increase. The best credit scores are because you have a high amount of credit availability, but a lower amount of credit usage. And anytime I get a credit score like, you know, hey, we'll increase your limit to X, and they don't have to pull my credit, they'll do a soft inquiry, which we'll talk about later. I always allow it to happen because it just means I've got that much more availability, but I'm also disciplined to only use this. So if you're not someone that has that discipline, don't do it. But if you're always tapping at the top, your credit score is always going to be hurt. That makes sense? All right. FICO score amount, installment loans. So, oh my gosh, this is a really big thing that's happening right now. So most of the clients that we see or have or deal with have student loans. And what is happening right now? You guys can interact with me. I don't want to sit and talk anymore. My throat's getting sore. What's happening right now with student loans and COVID? Nobody has the answer, or are you all muted?
Aren't they being delayed or
deferred.
postponed, or there's like deferred?
Yes. You have the option to defer them because of COVID, which is a wonderful thing. However, let me tell you how that's affecting the world that we live in. When you defer your student loans, the interest clock keeps going, okay? So right now with COVID, yes, you can defer, but the interest clock keeps tapping on. Some folks, if you're on an interest-based repayment, my gosh, that's awesome, it's good, but here's my challenge, and this is why I loathe student loans, is let's just say you took out a student loan for $8,000. Well, guess what? If you defer that loan for a year, you are going to owe probably $10,000 or $11,000 by the time you go next year, because the interest is hacking on top of your balance. So keep in mind that yes, those income-based repayments are great. Yes, deferment is great, but there's no free lunch. You are going to pay, and you are going to pay more because those interest keeps compounding on top of your balance. So there are clients right now that actually owe more than the limit or the balance or the initial loan amount on the student loan, and that's really hurting them because now they feel like they're over and above what their credit limit is on those student loans.
Michelle, can you please mute your?
Yeah, thanks. Let me see if I can go in and mute her. You got it, Michelle?
What? Oh, I think I took, yeah. All I can see is me now.
Okay, hold on a second. I can mute you. Participants, hang on.
I need to go quiet my.
There you go. I muted you, Michelle. Okay, thank you guys. Okay. So that's a really big factor that's happening now. And so be mindful of that, especially if your clients bring it up with student loans and things like that. There's no free lunch. They're going to pay the piper at some point, and it's just a matter of now or later. Also, the number of accounts. So sometimes if there's a gazillion student loans or a gazillion installment loans, just the sheer number of those kind of installment loans will act negatively because they feel like if you've got so many, you're already overextended.
Thank you.
Okay, next one. So approximately 15% of the FICO is based on length of credit history. So one of the biggest things that I can tell you guys, if you are new or young or your parents of kids, have a good credit card and put your kids on as an authorized user, because that will start their credit history fairly young. So my kids are 14 and 15, and I have added them onto my credit card as an authorized user. So automatically my history will be their history, which will instantly help them with this credit history challenge. Because sometimes when we have clients that come in and they're just out of college and they've only had a credit card for a year, their credit score is going to be arbitrarily lower because of this. Again, it's not the biggest one, but it does help if they've got longer history.
Wow. Hey, Lisa.
Yeah.
Oh, here.
Yeah.
That's very interesting. I love that little tip. How young do we do that at? I mean, my oldest is 10 and a half.
I mean, my kids are, I would probably say 14, 15 when maybe they're getting kind of old enough to start understanding money or credit, but I would do it at 14, 15, and that's leap years ahead of starting at 21.
Okay, great.
Yeah, so I just did it because I would give my daughter my card and then she would lose it, and then I'd, that whole process. So this way she's got her own, so when we lose it, then we have to do the whole process again.
Yeah,
a little bit more responsible.
I guess a second part of that question is not so much that I would even give my daughter the card at 10 and a half.
Yep.
That's what I mean. Like even right now, could we put her on as an authorized user and start building credit at 10?
Yeah, sure. There are people that I've seen credit reports on that literally I was like, they're like, wait, we don't know what that account is because their parents have forgotten about it. And they come and they're like, wait a second, we don't know what that credit card is. We don't know what that is. And I'm like, oh, okay, well, it was opened in like 2010. And they're like, well, we were like 13. I'm like, you're authorized user, parents account, no problem. And just so you know, like when we're looking at that, then it'll key our credit card or our credit report as an authorized user. So then we don't use that against them because they're not the primary on the card or a secondary.
Okay.
Lisa, this might be a
That's-
follow-up silly question to Bo's, but if I were to put my kids as an authorized user, does that mean I actually have to let them spend money?
No, no,
Or can
just like
I
what Bo
just have
said.
cards? Okay.
Yeah, just like what Bo said, it just builds their history. Now you want to be, mindful that you're putting it on a card that obviously you're good at, right? Like you're not maxing it out, that you're making sure that you're hitting all the payments, because what you do on yours then will reflect on theirs. So that's the only thing. Make sure that you keep that pretty tight.
So they'll get their own card, and does that card with their name on it have to have activity, or does it just have?
No, it's your activity.
Okay.
And you don't even have to give them a card, Elizabeth. I just did because my daughter lost mine twice and it made me angry. But you don't even have to give them a card. Like you can just add them as an authorized user. So if they literally had your card, they could use it, but you don't have to ever give them a card or get a card with their name on it. But it'll build their history.
Lovely. That's great.
Okay. So the other thing is too, is that if there is no activity on your credit profile for 6 months, you will no longer generate a score. Some people think that it's a great thing not to have any credit. It is not a great thing if you want to borrow money and have a good interest rate. So you actually have to have cards and use them. So I tell people, if you're really like anti-credit, get 2 credit cards or get in a car loan and use them for gas and grocery and pay them off every single month. But you have to use them or your credit profile will go dormant. Okay. Oh, and here's my authorized user thing that I told you guys about. Okay. And then FICO score and new credit. So a lot of times if people are getting a lot of new debt, again, this only does about 10% of the score. So it's definitely not one of the bigger indicators. And it will only review, Fair Isaac will only review the last 2 years. Some will, Equifax and Experian will only review the last 6 months. So again, they're not doing a whole lot of scanning for new credit. Okay, and then type of use of credit, again, mortgage is the most impactful.
Cute. I'm gonna go in here.
Okay, make sure you mute if you guys have other conversations.
That's why you love them.
Okay, 10% is the type of use. So mortgage has the most impact, installment loans, second most impact, credit cards are the third most impact. In a perfect world, you want to have a couple of these. Installment debt, student loan, car loan, boat loan. It can be even an unsecured loan if sometimes they have the overdraft protection will be looked at as an installment loan. So again, their ability to get installment loans versus just credit card loans is important. This comes up a lot in our world about rescoring. What does this mean to rescore? So it means that we're not going to let the credit bureaus fix themselves. We're going to push the information or the updated information to have the score reflect the change or the positive change sooner than maybe a month or so. So a lot of times if we're rescoring someone, it's because their credit score dropped because of something that maybe is inaccurate or credit usage. And it's pulling them out of a program or something that they want to use. And if we can get their credit score higher, they'll qualify. This is why we would rescore, okay? It's not going to fix any of your bad history. So unless that history is reported as inaccurate and you give us confirmation that it was inaccurate, like maybe there was a 30-day late and it was not a 30-day late, and you get us documentation that confirms that that was an erroneous error, then we'll rescore and your credit score will improve because that bad data now has been removed. But rescoring is not something that we do very often because most of the time the data is accurate. It's only really probably the most we do is if you've got a high credit limit and you're paying it off and it's going to pop your credit score to get you a better interest rate or get you into a program.
No.
So again, here are the reasons that we would rescore someone. All right, so here are just some
Oh,
random
man.
tips for raising your credit scores. Kelly, I think I'm going to try and mute you because it seems like there might be background noise. Okay, there you go. Perfect. Thank you. Okay, obviously pay your bills on time. Don't close credit cards. This is a really big one, guys, because everybody thinks that, oh, if I close my credit cards, that will help. No, it won't, because what I said earlier with the amount of credit usage that you have, the more you have available and the less you use, the better you're going to be. So when you close a credit card, your credit usage went down, and that will affect your credit score. So much of credit, I feel like, is contrary to public or common knowledge or common sense. So again, the more that you have, the less you use, the better you're going to, better credit score you're going to have. Okay, we'll keep going. Now we're going to get into a little bit more mortgage related stuff. So bankruptcy, if you've had a bankruptcy in the past, every loan that we do has a little bit different waiting period. 4 years for conventional after a Chapter 7. So Chapter 7 is when you wipe out all of your debt and you basically get to start with a clean slate. Chapter 13 means that you have debt and you are basically putting it all together and you're paying it off. Maybe you've negotiated it, maybe you've negotiated down, but you're paying it off. And so that's a payoff period that you're going to then make your debt whole. FHA obviously is a little bit more lenient than conventional. If I keep going, USDA and VA are going to follow more along the lines of FHA. Conventional is going to have the hardest and the longest waiting requirements. And this is just for bankruptcies. Short sale and foreclosure are going to be different. Foreclosure means that you basically let your home go back to the bank. Short sale means that you tried to negotiate with the bank and tried to sell it, and you ask the bank to take less than what they were owed. That's a short sale. So a foreclosure will have big impact on your credit score. However, what matters is your payment history before the foreclosure. So if you didn't really have any lates, or you had a couple of lates, and then you let the bank take it back through foreclosure, your credit score may not be as bad as if you had a short sale with 12 months worth of lates and then let the bank deal with it. So there's no, black or white. It's a lot of it is more about the history versus the act of foreclosure or the act of short sale. And then here are the waiting periods for the different loans with regards to foreclosures and with regards to short sales. So for all my realtors on this one, this is a great Bible for you guys if you ever have clients ask you these questions. These really don't change a whole lot. They've been the same for many, many years. Tax liens, this kind of stuff is very interesting. So tax liens will stay on your credit 7 years after they've been released. So not only are they going to punish you because if you haven't paid them, once they're released, they do stay on and kind of pick at your credit score a little bit. Same with state tax liens, again, 7 years from the date of release, and then judgments, any civil judgments from the date of satisfaction. So they're all kind of the same. They will do lots of damage if they are unpaid. Once they are paid, the damage lessens, but it's still on there. This is a good one for people. I get this question all the time. Hard inquiry versus soft inquiry. So a hard inquiry means I am taking a look at your credit. I am requesting credit score for a specific pre-approval application, etc. I will look at your credit scores and the inquiry will show up. A soft inquiry is not visible to lenders. So a soft inquiry would be done if you were doing any background checks for getting a job, looking for insurance, Credit card companies doing pre-approved offers. It does not affect your score. And the key is it's not linked to any specific request of approve me, don't approve me. That's where a hard inquiry comes in. So people ask us all the time, will you do a hard inquiry or soft inquiry? I will always do a hard inquiry because a soft inquiry means nothing to me. And if I'm going to pre-approve you and I'm going to send you out into the world to sign a contract and commit earnest money and I'm going to guarantee that I approved you, I got to have all the data from all 3 bureaus. Okay. Should you pay off collections? This is a really good one. And again, counterintuitive to common sense. So when we're looking at mortgages, FHA will allow you to not pay off collections, or if you've got 2 or 3 collections, as long as the amount of the total collections is $2,000 or less. So again, you can have collection accounts out there as long as the amount is $2,000 or less. If you're doing FHA, that also covers for VA, etc. The other thing is, if you have an open collection account and it's currently reporting, then in general, yes, we should say pay it off. But if you've got an old collection that hasn't reported to the Bureau in a year, 2 years, 3 years, and now you go and pay it off, well, now you're almost reopening that bad debt. Even though you're paying it off, you just reopened it and it could cause your credit score to go down. So a lot of times we will tell you, leave those things alone, because it's almost like opening a little flesh wound and your credit score starts to bleed again if you repay it after it's been dormant for a while. So weird things that I think don't seem counterintuitive, or seem counterintuitive and not common sense, but that's credit. This we see sometimes on credit bureaus. So if you have something that you don't agree with, or you think that there was an error on a account and it was something that you want to dispute, what happens in our world of mortgage is when you dispute a credit card or charge, it shows up as a dispute on your credit card or on your credit bureau. And what happens is that trade line now is removed from the scoring model because it's disputed. It's almost like frozen in time. And so if that dispute has got lates on it, we will make you remove the dispute so that that dispute then will go and be cleared through the credit bureau. Because if you've got lates and it was in dispute, those lates are not factoring into your credit score, and it could actually adjust your credit score. So disputing accounts is fine, but be really careful about what you're disputing. If you've got a late history with an account, don't dispute it, because it's going to mess up your credit score. If you've got a perfect payment history with them and you're arguing about one charge, fine, dispute it, because that way we really don't care, because you've never had late payments on it. I hope that makes sense. That's kind of a weird one that we have to explain sometimes if it comes up for clients. How to remove disputes will help you with that if it ever has to come up. But here's also information if you want to dispute something or remove dispute aversion information, or if you see a credit report or you get a free credit report annually and there's something incorrect on it, here are numbers that you guys can also call to fix them if there's anything wrong or an error. Okay. Guys, that is it. That's all I've got for credit other than your questions. So I'm going to quit sharing my screen. I'm going to open it up for questions. Now I can see the chat box. Oh, it's so nice. Okay. Dave. Oh, you're welcome, Dave. Okay.
Lisa, you had a slide. You
Yeah.
had a slide earlier today. Number one, can you share this deck with us?
Yep. I can absolutely send it out when
Gotcha.
we're done. Yeah.
Because that answers the question. You had a thing about conventional for 7 years and VA
Yeah.
chat, all that. That little slide there had a lot of great information just to be able to know as an agent for people that ask those specific questions.
Yep. We'll send our deck out to everyone that was on the call, because I do think for agents, that's kind of a nice little Bible that you've got available.
Great. Thanks so much.
Yeah. Bo, you're asking me, how do those credit boosters work? Give me more info on that. I don't know what you're meaning, credit booster.
Oh, you just see those commercials where they're like, instantly boost your credit. Just go to this website and do whatever. I'm like, what does that do? Do we even know? Yeah, I mean, I don't know what they're, it's like you're filling out some form. I've never done it. I have no idea. I just see the commercials and I just was curious if you knew any information on it.
I don't, and I don't know what they would be doing because there's no free lunch. People think too, like, sometimes we'll see clients that have a lot of credit card debt and they go to like those consumer credit counseling groups and they consolidate their debt, and then the counseling group will actually renegotiate their debt to make them owe less, and then they work on paying it off. So people think they're doing the responsible thing and putting their credit together and trying to pay it off. But what is happening is you're basically raising your hand and saying, I'm not going to pay you as I agreed to pay you in our original credit card agreement. Now I want you to take it in the shorts and I want you to reduce because I can't make my payments. So that actually is a big negative on your FICO score, your credit history.
Okay.
So if they're doing these credit boosters, I'm not sure what they would be doing other than maybe looking at your credit profile and trying to get you more credit so that your usage, or they're reviewing how your payment history has been, or if they're removing you or looking at your usage and saying, take this balance and move it over here and do this and do that. I don't know what else they would be doing because there's just not that many ways to do it other than the, credit history and the usage and kind of how those balances work. That's the biggest thing.
Interesting. Okay. Yeah, they make it seem so instant. You can do it on your phone, go through some stuff and boost your credit, 20 points, 15 points, whatever. So,
I would be leery of those because I don't know. I mean, I just think a lot of times people want a free lunch. That's where, and maybe it's like the credit score, the rescore that we're doing, but only if there's inaccurate data and you have to prove to us that there's inaccurate data. Or, oh, you maxed out your credit card this month because you use it for expenses and your company was late giving you your expense check and now it's down to 0. That's about the only thing I can think that they would rapidly adjust it.
Okay.
But good question.
You brought up something else too regarding debt consolidation. So you're saying, is it SoFi or some company like that can help wrap it all into one? You start making one payment. You're saying not
I don't
good.
mind SoFi at all, actually. It's more the consumer counseling where they're negotiating on your behalf to reduce. Let's say you owe $5,000 to American Express and this group goes and says, hey, American Express, we'll get you paid off in the next 12 months, but we're only going to pay you $3,000. Will you take that, or we're going to wipe it out via bankruptcy or something? So then American Express will agree to take $3,000, but now American Express can actually mark you late because you're not paying them as agreed. You renegotiated your contract with them. So it can get very sticky. But keep in mind, when we're looking at the consolidation, like that 0%, like you get really enticed with, take all your credit cards and put it over here at the 0%. That's great, but keep in mind, 30% of your credit score is driven off of usage and how much you've got out there versus what's available. So if you take those and you basically get a new credit card for $10,000 and you take all your credit cards and you slap them on that one, well, now if you owe $9,500 and your balance is $10,000, you're not doing yourself any favor other than how much you're paying back. So there's a really fine line on how to do this, and I get the amount of interest. I get that. However, depending on what you're doing, the more higher credit score you have, like if you're doing a mortgage, that can save you thousands and thousands and thousands of dollars over a life of a mortgage because your interest rate will be better on a higher credit score than on a lower credit score. So there's lots of different things. And again, it works for some people, but it's not a fix for everybody, that's for sure.
Okay.
I have a question for you, Lisa.
Yeah.
If you have a client with not great credit, or not a lot of credit, I should say, what do you think about having them go and get a secured card and work on that for a little while to help build some credit and some history?
I think secured cards are great. So basically what that is where you go to like a bank and basically you put in maybe $500 into an account and they'll give you a credit card, and that is the security. That bank account is the security for that credit card. So I think that's a great option for people that have very little or they have a tougher history. But then here is where the authorized user would also come into play really well. If they've got someone else that can be added, or they can be added to their credit, and they've got a nice history and they've got a good payment history, that will do just as much as the secure credit card. But not everyone has that, so that's a good alternative.
Okay, great, thank you.
Mhm. Other questions that I can answer on credit? We're almost at the top of the hour, so again, I just want to make sure.
I had a question, Lisa.
Yeah, Jen.
So if those that don't like using their credit cards and might be, I guess, dormant, so to speak.
Yeah.
Would you just essentially start using those cards again, and then it would kind of start the, like you said, gas, groceries, all that, and then pay them off? It would just kind of be undormant and then.
Yep.
Fine. Okay.
And so if you go dormant because you don't have any use, it usually would take about 30 or 60 days of usage for then that credit score to pop back up and happen again.
Okay. Okay. Thank you.
Yep.
And Lisa, did you say that at least one charge has to happen in 6 months?
Yes. So you have to have, if there is no activity on any of your accounts in 6 months, your credit score will cease to exist.
Oh, on any of the accounts.
Yeah, so if you have a credit card and you use it on a monthly basis, you're great. But if you have not one swipe of that card in 6 months, and that's the only thing you've got, you will not have a credit score.
You know, I had some
No
really
credit
good
score is
advice.
not good in our world.
I had some really good advice on that, which is that if there's cards that you don't really want to be using, like have them in your wallet and take them out and have the risk of potentially impulse buying or something, attach your monthly Amazon Prime payment to it. Or like I order dog food, comes once a month, $50. So it's never very much. I have automated going to my credit cards, maybe $50 or $100 a month.
Yep.
And it's just those automated things. So I don't have to think about using those cards, but it's paying for things that are automated, and then I just pay those cards off.
Yeah, I mean, that's a super good idea as well. My only thing is don't forget about them, because sometimes if those things come up automated and maybe you think, oh, I haven't even used that card, that sometimes then people will forget to pay that card because they think they don't have a balance and they forget about the automated. So I love that idea, but yeah, it's just little things that are just will make all the difference. What else? Any other last minute questions, concerns, anything about credit, history, thoughts? Good?
Thank you,
Yeah.
Lisa, very much for your
Thank
time.
you. This was awesome.
Okay, so I will send out kind of the deck that we went through together so that you guys all have it. And like I said, I think it's a great reference if people have kids or just, working on their own credit. It's a great resource. And I just think there's so many myths out there that people don't know, or just, they've learned it from their parents and things have changed. So we just want to make sure that we're always the voice of reason for people.
Thanks so much,
Okay,
Lisa.
guys.
This was great.
Thanks for joining. Good to
Thank
see
you.
guys. One of these days we'll be back into the office whenever you guys feel comfy. I'd have to just start dressing nice from the bottom all the way down, right? I don't get to wear jeans anymore. Okay. All right, guys. Have a great rest of the day. We'll see ya, and I'll get these out later.
Thanks.
Thanks,
Bye,
you
guys.
too, Lisa.
Thank you.
Bye. Thank you.